Otherwise, then you'll have to calculate the regular way,
Right.
weighted average. Yeah. Okay. All right. So there's a hierarchy of these means. Generally, AM is bigger than GM is bigger than HM. Uh, Geometric mean assumes compounding, right? So if I say at the end of 2 years, I'm earning 20%. So per year, I will not earn 10, I will earn less than 10 because of compounding. So interest
Okay.
at the end of year one is also reinvested and you earn interest on interest in year two.
Yes, sir.
And hence geometric mean generally will be lower as compared to arithmetic mean. And same is the case for harmonic mean. Yeah.
Got it.
In the bound, they could be equal if the returns are equal. Yeah.
Yeah.
And difference between AM and GM increases with volatility of returns. More volatile the returns, higher is the difference. Okay, so these are some important things about AM, GM, HM. Okay, so where are they used? Arithmetic mean forecasting the return for a single future period. Yeah. Geometric mean compounded rate of return over multiple periods to evaluate past performance. Harmonic mean is to calculate average cost per share for
Right.
dollar cost averaging strategy.
Yes, sir.
Yeah. And there's something called as trimmed or Vinsorized mean. So that's removing the impact of extreme outliers because generally when you take outliers, they will
Yeah, your
impact
mean
the
gets affected.
average.
Yeah.
Yeah. So for instance, there are two ways in which it can be impacted. The mean. You can have a distribution like this or a distribution like this. The first
Yeah.
one is the positive skewed,
Second is the
where
negative.
where the mean is shifted to the right because of outliers here
Mm.
in the positive tail.
Yes.
So the mean increases there, correct?
Mm.
Shifted towards the right. This is a negatively skewed
See,
distribution. Opposite
you have
happens.
negative
Right?
outlier.
Yeah, negative outlier, and hence it's in the left tail. So your mean actually shifts towards the left or falls. Yeah.
Got
Okay. Interest rate from which inflation premium has been subtracted is known as what?
how much inflation? Real interest rate.
Real interest rate, right? So nominal minus inflation is real. Okay.
Right.
Stock with varying returns over 6 years, the mean annual return is most appropriately calculated using
Can't be
geometric mean,
harmonic.
right?
Geometry. Yeah, it has to be geometry.
Multiple periods, varying returns. Yeah. Okay. So we are done with this deck. Coming back, there are a couple of more concepts which I would like to touch upon. There's another kind of return called as CAGR.
Yeah. Compounded annual growth.
Yeah. So what is this? How is it different from others? How is it different from HPR or geometric return? In CAGR, you're assuming, sorry, in geometric return, you're assuming compounding every period.
Right.
Hmm? In CAGR, what you're doing is you're taking ending value, dividing it by base value or beginning value,
Mm.
erasing it to 1 by n and subtracting 1 from it.
Got it.
So suppose today the stock is 100, after 5 years the stock is worth 300.
Right.
So 300 by 100 raised to 1 by 5 minus 1 will give me the CAGR of my
Okay.
investment. Yeah. So that's the compounded annualized growth rate. Make sense?
Got it, sir.
Hmm. So this is a good landscape of various returns. I've just put it on one slide. Any questions on this? All okay?
Yeah, all good.
Okay, let's go for a few problems. Let's see if we have.
Should I just come and grab my calculator?
Yeah. Sure.
Yes.
Yeah. So if you can try this, this is easy.
Last year the returns for active corporation. So I think here you use geometric, right?
Yeah, you'll have to use geometry because single period returns are given. If you have beginning value and end value in terms of price, then you use CAGR.
Yes. So 1 minus 9.34. So he will take a percentage value, right? So yeah.
Ah, so what will you do here?
So 1 minus 0.0934. What?
Yeah, yeah.
I'm getting 6.824%.
Yeah, 6.825.
Yeah.
Okay, good. Are you using T1 or HP? I mean, TI or HP? Which
Here I
calculator?
use Texas Instruments.
Okay, okay. All right. Cool. Next, harmonic mean. I think this is easy. We've just done this. 3 divided by 1 by 8 plus 1 by 9 plus 1 by 10.
Yeah.
Correct. 8.927. Okay. Right. Okay. Can you tell me, is most appropriately calculated using what? The mean annual return.
I do 5. Here we'll use geometric.
Okay. Yes.
Yeah.
Compounding.
Geometric. Yes.
Yeah. All right. Next, set of bifurcated returns. So another bifurcation of returns, okay? And realize returns that too. So I'll just put it out here. Is based on two important concepts: time weighted and money weighted return.
Yes.
Yeah. Now let's understand what these are in simple terms. Okay. Now, so this gives a good comparison of the two types of these returns. One is called as time weighted, the other is money weighted. Now, time weighted return is what the manager quotes for investment performance. Here, the fund manager is not really bothered about when the cash flow is coming. The timing of cash flows is ignored or neutralized. and hence it's preferred as a generic, return measure by fund managers or performance analysts to have an aggregated view of how much return the fund earned. So that's time weighted return. Again, it measures compounded rate of return, but removes the impact of cash flows or the
Right.
timing rather. Money weighted return, on the other hand, is when you invest or I invest in a fund.
Mm.
Suppose I invest on 6th of July and I keep it for a year.
Right.
So from 6 July 25 to 6 July 26, how much would I have earned?
Yeah.
Yeah. Especially if I, have different investments which I keep making into the fund or keep withdrawing some money from the fund. Then how much do I make? From an investor's perspective, that return is money weighted return. Okay.
Okay. Got it.
So that's from an investor's perspective. And it accounts for when the money is added, withdrawn. Timing of cash flows are important. So cash flows are included and impact the result heavily. Yeah. Okay, so let's see the difference on the next slide. So here we have the context set up here. Uh, at T0, you're going to purchase one share at 50.
Yes.
Can I say in terms of a cash flow diagram that is minus 50?
Correct.
Uh, then you have at T1, you receive a dividend of 2 on that one share which you bought. And you're also adding another share. You purchase another share, the price has gone up to 53. So can I say your net cash flow is minus 51? 2 minus
Yes.
53.
Yeah.
So again, negative cash flow at T1. At T2, you receive 4 dividend on those 2 shares.
Yeah.
And you also sell 2 shares at 54 each. So your total cash flow becomes 2 into 54 plus 4, which
That's
is 112.
correct.
So money weighted return is nothing but your IRR, internal
Right.
rate of return,
Internal rate of return.
which will make your NPV zero. So it's like a break even required rate of return on this investment.
Got it.
So you have all the cash flows in the numerators, and then you divide by 1 plus the money weighted return rate, which is R. Okay.
Yeah.
And when you solve for this, for instance, here you get 7.117%. So that becomes your MWR. So it's very akin or similar to IRR.
Yeah.
Make sense?
Yes.
So how is this different from TWR? In TWR, it's very similar to what we have learned, which is holding period return and then multi-holding period return and the geometric mean of that. So your time weighted return is nothing but the geometric mean only, in
Yes.
short. So you can calculate period one return, which is, can I say, ending period value, which is 53 minus 50 plus the cash flow, which is 2. So you earn 5 divided by 50 is 10%. And in period 2, you get 104 by selling, but your cost was 106 at the end of period 1. So again, period 2 return is between years 2 and 1. So your base changes in year 1, right?
Yes, sir.
And your base is two shares at 53 basically, because I've already accounted for the rise of one share in period 1. So period two's perspective is always from the end of period 2 versus the beginning of period 2.
Yeah. Right.
Okay. And the dividend and the income earned. So it becomes, and the base also is the same, which is your cost at the end of or at the start of period 2. Your cost is 106, right?
Yes.
So 5.66, and then you put that into factors, raise by half, because these are 2 periods, minus 1, and you will get geometric average. Yeah. So
Yeah.
although managers' performance shows 7.8%, but in reality, investors' actual rate of return on the basis of IRR calculation is
711.
7.117, because here you're assuming compounding every period in IRR.
Yes, sir.
Yeah. So that is how it's calculated. Make sense? Also, if you note, your MWR is lower for the investor. And one of the reasons is, or the core reason here is that if you observe, the investors added money
Yeah.
after earning 10%.
Hmm.
And then the second period return is only 5.66%. So that
Yeah.
drags down the money weighted return. So that's the reason why MWR is lower.
Oh, got it.
Yeah. Timing of cash flow.
Right.
Yeah. Okay. So that's your TWR versus MWR in practice. So TWR, can I say, is from manager's perspective, and MWR is investor's perspective. Also, TWR is similar to geometric mean, which again is covered here.
Yeah. Right.
And MWR is IRR.
Ah,
So that's your entire gamut of returns landscape.
right.
The same we will do when we come to risk later on. We will create a landscape for risk. So in one slide, it's a good overview of everything.
Got it.
Yeah. Let's see if there's anything left in this reading. So we have already solved these examples.
Yeah. Right.
In fact, you can try this slide number 30. You can try later. Okay.
Okay.
So this is in the reading one PPT
Okay.
or notes. Slide number 30, reading one. You can also solve slide number 35. That's TWR. We've discussed both of these.
Okay.
You can try these two. And there are some quiz questions on 39, 41 also. Yeah,
Okay.
these you can do. Just a couple of more things before we close out today. One is uh, annualized return. Can I say HPR can also be calculated for any unit bucket of return? I can also calculate HPR for 6 months.
Right.
But then how to analyze that? So whatever return you calculate, so 1 plus that return raised to 365 by days. For instance, if it were 6 months, yeah. So
Yeah.
whatever HPR you calculate for 6 months, raise it by 365 divided by
180.
180 minus 1. Basically, you're just doubling the rate, right?
Yeah. Right.
So you're saying, okay, the concept is simple. In six
180 days.
months, you earn this. So
How much
another
will you
six
earn in?
months, you earn the same. Yeah. So how much will you earn in 1 year? So compounded, right?
Yeah.
This 1 plus this into 1 plus this, and then raised to,
1 million.
it's square only here. So it's square.
Or yeah.
And then minus 1. So that will give you annualized. Because your bucket is 6 months, 6 month. So this is how we annualize. Similarly, if it were quarterly, there would be 4 quarterly buckets. So raised to 4. So 1 plus quarterly return raised to 4 minus 1 will be your
Okay.
annualized return.
Got.
Yeah. So we can add this to our deck, annualized return. Is also 1 plus HPR raised to 365 by days minus 1. So how to annualize the return? Got it?
Yeah.
This is also an offshoot of HPR, another
Yeah.
variety of HPR. Okay?
Sure.
Yes. So for instance, if you deposit 100 into a bank account, after 90 days, the balance is this much. What is the saver's annualized rate of return? Yeah. So what is HPR here? HPR will be 100.75.
5/100 minus 1.
Correct.
And then find annualized, you add it to 1 and 365 divided by raised to 365 divided by 90.
Correct. Absolutely. Yeah. So that's your annualized return. All right. Couple of more things which I will do next time
Okay.
because I want to do compounding properly. It will take me 5-10 minutes more to do compounding. So I'll do
Okay.
it next time when we start. So that will complete this first reading. So we'll go reading by reading and we'll try to complete the syllabus first. Yeah.
Sure, sir.
Practice questions. Some of these I've already given you some 5-6 questions from here.
Yeah,
So
you
you
said
can,
slide numbers and stuff.
yeah. So we will also host an LMS plus I will also share this on the WhatsApp group.
Okay, sure.
So you can do this right away. Just going to share it with you.
Okay.
Any questions?
No, no, sir, not really.
Okay, cool. My pace is okay. Is it good for
Yeah,
you?
no,
Okay, okay. Cool, cool. Great. So I'll see you soon then, Yash. Yeah.
yeah. So I'm meeting on
Okay.
Thursday?
Thursday we'll meet. Yes.
Yeah, sure.
Okay. Thank you. Bye bye.